It is almost mid-May, and we are still hoping for warmer weather here in the greater Milwaukee area. So let's take a look at the real estate market and see how we've been holding up with the impact of COVID-19. We have about 2 months worth of data right now, and can look at the impact that this situation has had on the local real estate market. And the question that I get on an almost daily basis, how is the real estate market? I have to answer it in two different ways, because buyers and sellers are behaving and responding completely different to this current situation. And that is creating an interesting dynamic in the marketplace. So we're going to take a look at that, what that means for local inventory, what that means for house prices and home values. And then we're going to take a look at the broader economy and interest rates, and what might be in store for us for the next months going forward. So let's take a look at the seller side and at local MLS data here from April. And the big story is right here is when you look at homes listed in April, we are down almost 40%. And that's the same regardless if you're looking at the Milwaukee metro area, which includes 5 counties, or if you look at Milwaukee County, Ozaukee County, it's basically the same story. We are close to 40% down compared to last year. And that is pretty much the sellers hitting the pause button. They're being concerned, having a lot of people coming through the house, and they're putting this on hold until further notice. And this is driving, the rest of the numbers, and this is the driving force at the moment in the marketplace. Let's take a look what buyers are doing. So, as you can see here, that's a completely different story. We have in orange here the showing traffic for Wisconsin of the last weeks. And you can see the impact here of the safer in place order. And the last weeks, buyers have become increasingly restless. We've seen an increase in inactivity, a lot of online showings in that time, but now we're back to physical showings, and we have actually exceeded last weekend the benchmark set by last year. So the blue line here was showing traffic from last year. You can see the Easter weekend here last year, and we have now officially surpassed activity last year, regardless of the situation that we have with COVID-19. So very different story here. And it shows also when you look here on days on market. So we're down to, in April, 30 days on market on average. And I have seen that in my own experience as well. Most of the deals that I have been part of over the last 2 weeks were extremely competitive. We had to write offers very quickly. We received multiple offers over asking price. So that is just the very fast-paced situation right now. And I will not be surprised if we're going to see about 20 days here in the low 20s when the May numbers are going to be out. We'll take a look at this at the June market update. And also you can see here the sold to list ratio. So this is measuring how much money sellers are getting at the end of the day compared to the asking price. And we had dipped down here for the winter months, and now we are back at 100% on average. And also here, I will not be surprised if that line is climbing over the 100 mark as soon as we're going to see the May numbers. That's the experience that I have on a daily basis. We're in a very, very competitive market right now. So this is a stat that I pay a lot of attention, because it's as close as you can get to the pulse of the market, because this is weekly and this is accepted offers. So this is how many buyers have made an offer last week and how many sellers have accepted that offer. This is as close as you can get to the pulse of the market. When you look at sales, at closed listings, that is a month later. So that's a lagging indicator. Here we're right on in real time, and you can see last week was the strongest week, on par here with early March, with 539 properties going under contract. And you can see that's quite a bit more than we had on average in the last 8 months. So, very, very hot market. And it becomes even more visible when you measure it, accepted offers in terms of percent of the inventory. So last week, we have sold 9% of the inventory that is currently available on the market. And again, that's accepted offers. So a very real-time indicator. And if you compared it with November, December, we were at about 3-4%. 5-6% is usually the average. So 9% is an extremely high number. Then looking on the listing side here, this is going in the right direction. These are new listings per week. And while we are still very low, I think more and more sellers are recognizing the exceptional opportunity that there is right now. The real estate industry has developed some very good standards on how to safely bring a house on the market with, keeping the risk for everybody, for all the parties involved, as low as possible. And as the as time is progressing, I think more and more sellers are recognizing this. And also we will see, as our state is slowly moving towards opening up again. We have seen yesterday the Supreme Court overturned the governor's stipulation on this. So we're moving in the right direction. And I think we are going to see more inventory as more and more sellers are taking advantage of that, quite frankly, unexpected situation. So let's take a look at pricing here. This is also MLS data as of April. And what you can see here is a comparison of April this year with April last year. And we're looking here at the median sales price. You can also look at the average, but I think the median is the better indicator. And April over April, we're up 11%. If you compare it with year to date, so that's the, what happened so far in the year, we are still up 8.6% with a median now of $179,000. So by the way, I'm making these videos once a month. They usually come out around the 14th, 15th of the month. And if you are seeing this on YouTube, you might want to subscribe to my channel and get notified the next time I have a video ready for you. All right, let's take a look at the US housing market for the bigger picture. And what we can see here, if it's loading, is seller traffic, measured. This is BC before COVID. And you can see the traditional picture that the more southern states have already started getting very active with putting properties on the market. And the more northern states, as expected for February, have been a little bit slow. Let's take a look at March here. So this is the impact of COVID, and you can see that basically sellers across the nation have completely shut down with, a few minor exceptions. On the buyer side, this is what you would expect for February on a normal year. So we have a lot of activity on the buyer side, very different than on the seller side. But now the really interesting thing is when you look at buyers traffic in March. So you can see not that much of a change. The areas that have been impacted the most, no surprise, are those that have been most impacted by the coronavirus. So you have in New York and the East Coast, you got Florida, you got California, Illinois to some extent. So this is where buyer traffic is a little bit muted, but for Wisconsin, we're still going strong, as you have seen before on the data. So, on a national level, basically the same thing happening that we are seeing in Wisconsin as well. So let's take a look at distressed properties. So from my investor clients, I get a lot of questions about, hey, are we going to see foreclosures? Is that going to be a buying opportunity? And there's a few things you should know about. First of all, foreclosures take in Wisconsin about 18 months. So whatever we might see in foreclosure inventory will not show up until 2021 and 2022. Personally, I think the entry and medium price levels are fairly well protected by unemployment money and stimulus checks. So I don't think we will see too much of an impact there. Where I'm a little bit more worried is the luxury segment, over $500,000, over $600,000. I think we may see some casualties there because some people may have made too much money last year, so they're not they're not getting a stimulus check. They may be a business owner and might be impacted. And so we might see some casualties in the luxury segment, but that's traditionally always moving a lot faster. Even if you look at Ozaukee County properties, everything over $600,000 is moving on a very different pace than, let's say, a $350,000 property. So we might see some casualties, but again, it will not impact the market until next year or the year after. A quick warning here on mortgage forbearance. So as you might know, you can request from your lender to not make a mortgage payment in this situation. You can hold off for 3 months. And what you would expect and what some lenders are doing is that you add those 3 missed payments at the end of your mortgage. So, after 30 years, you add 3 more months to make up for the payments that you've missed out. From what I'm hearing and seeing, that's not always the case. And some borrowers get hit at month number 4 with the expectation of making 4 payments at once. And of course, if you're in a situation that you cannot make your mortgage payment, it does not really help that in 4 months from now, you have to make 4 payments in 1 month. So that is something, somewhat of a dangerous situation. And if you know somebody who is looking into this, then make sure they're paying attention to this, how this is going to be structured, and most importantly, get it in writing from the lender. But as of right now, distressed sales are very low. So we're measuring the distressed sales, by the way, that includes foreclosures and short sales. And when you go back here, we had a time, this is national data, we had a time in 2010 when we were like, 48, 47% of all sales back in 2010. And, right now we are as low as about 3%. And this number will probably creep up a little bit, but not before 2021 or 2022. Let's take a look at some of the reasons why I'm so, optimistic for this. Number one here is that American homeowners, Wisconsin homeowners, are sitting on a ton of equity. So when you look at this, almost 60% have at least 60% equity. And there's a huge percentage that actually own their home free and clear. So there is a lot of money that, makes homeowners more resilient to any economic disturbances that we're seeing as a fallout from this. And, the other thing is housing supply. So we are, very different situation from 2008 where we had an oversupply. We have a supply shortage, and these stats go here all the way out through March. We're missing here April and May numbers at this point. I hope I will have them next month to show them to you, but I expect those numbers to be deeper in the red. So the inventory imbalance, the shortage that we have on supply will most likely continue and most likely even increase as we're moving forward. When we're trying to look at the economy, GDP is one way of looking at that. We already know that the first quarter was bad, GDP down almost minus 5%. And I have here the estimates from Goldman Sachs, JP Morgan, Morgan Stanley, and Wells Fargo. And as you can see, most of them are predicting that all of them, Wells Fargo is a little bit more optimistic here, but most of them are predicting that the second quarter is going to be a complete disaster. I'm sure you're not surprised about this. And then here we can see quarter 3 and quarter 4. So depending on which one of the 4 you believe, we are going to see more or less strong recovery in the third and in the fourth quarter. This might even stretch out into the first quarter of 2021 before we're getting back on track. So this remains to be updated as the light is becoming clearer and we're seeing what's going on. But this is the current estimate of these 4 financial institutions. And then, last but not least, looking at interest rates. So we had historically low interest rates. It is a really good time right now to refinance. That's always a good idea to take advantage of that. And the outlook actually is pretty favorable for borrowers. So we're currently seeing a little bit of a tightening of the lending standards. Some of the bigger banks like Chase and Wells Fargo are not doing jumbo loans anymore. They're increasing their standards for some of their products as far as credit score. I think that's a very natural reaction of the lending system. But overall, clients seem to have no problem securing a mortgage in the last weeks. And as far as the rate outlook is concerned, it seems like rates are going to hold stable, if not going down So Freddie Mac is thinking here we might even see 3.1 towards the end of the year. So of course that will put more fuel on the housing market, because the lower the interest rates are, the lower your monthly payments are, and that means for buyers that even with higher prices, and we've seen prices pushed up in the last few years, even with higher prices, your monthly payment is holding stable because of the lower interest rate. So that somewhat offset the impact of the increased prices that we've seen over the last years. All right, so in summary, I think the housing market is very well and alive. Actually, we're seeing an inventory squeeze due to COVID-19, and so it's difficult right now for buyers to get a good deal. You have to be very smart and you have to be very quick, but it still can be done. Hopefully, we're going to see more inventory in June and July as sellers are coming back and are releasing the pause button a little bit. We should see more inventory come on the market. I think they're also seeing the unexpected opportunity for sellers, and the real estate market, the industry has actually done a very good job coming up with ways to conduct showings and transactions in the safest way possible for all participating parties. So I'm carefully optimistic here for the summer in terms of seeing more inventory. And thank you very much for watching, and I'll see you again mid of June.